December 31st is not just New Year's Eve. For Canadians, it's a financial deadline. If you miss it, you can lose government grants, tax-free growth, and future contribution rooms forever. Good evening, friends. This is GSCPA from beautiful Montreal, Canada. And today I will explain what you should do before December 31st in simple words with examples. Stay tuned. Let's start with the FHSA, which stands for First Home Savings Account. This account is only for first-time home buyers. So if you have never owned a home before, this is one of the best financial tools Canada has ever introduced. Now here is how it works. Each year you are allowed to put in up to $8,000. Over your lifetime, the total limit is $40,000. That's it, not more. The big advantage is this. The money you contribute is completely tax deductible, meaning it reduces your taxable income. And when you use this money to buy your first home, you can withdraw it completely tax-free. So you get a tax benefit when you put the money in and you pay no tax when you take it out for your first home. One very important thing to understand is this. FHSA room does not automatically carry forward like a TFSA. So if you were eligible this year but didn't open an FHSA, you permanently lose that year's $8,000 room. That means less tax savings and less money for your future home. Guys, that's real money left on the table. Now let's talk about the TFSA, tax-free savings account. Most people know that money coming out of a TFSA is tax-free. But what many people do not understand is when to withdraw. Here is the key point. Your TFSA contribution room resets on January 1st. So let me give you a simple example. If you withdraw $10,000 in December, then on January 1st, you automatically get that $10,000 room back. But if you wait and withdraw the same amount of money in January, you will have to wait until next year to get that room back. So if you need cash for any reason, December is the smartest time to take money out of your TFSA. Next is the RESP, which is for your children's education. With an RESP, your contributions are not tax deductible, but the growth inside the plan is tax sheltered, which means no tax while it grows. On top of that, the government helps you. For every dollar you contribute, the government adds 20%. So for example, if you put in $2,500, the government adds another $500 for free. That $500 is the maximum grant per child per year. And over a lifetime, the maximum grant is $7,200. Here is the important deadline. If you don't contribute to the RESP before December 31st, you lose that year's government grant. You cannot go back and claim it later. So skipping RESP contribution means skipping free money. In my next video, I will explain what happens to RESP money if your child decides not to go to college or university. Now let's talk about RRSPs. Yes, the official RRSP deadline is March 2nd, not December 31st. But smart planning doesn't wait until the deadline. December is the best time to look at your income, estimate your taxes, and start setting money aside calmly. This way, when March comes, you are not borrowing money, you are not panicking, and you are not making rushed investment decisions. Good tax planning is not last-minute planning, it's early planning. One last thing, guys. Please don't take tax advice from someone who just bought software and called themselves an expert. Proper tax planning requires education, licensing, and real professional experience. This is your money and mistakes can be expensive. If this video helped you, please share it with your family, especially parents and young couples. Guys, good planning saves money and bad planning costs money. This is GSCPA from beautiful Montreal, Canada. Thank you for watching.